You're welcome, sir. We are with you, sir.
All right, thank you.
All right, thank you.
Honestly, I didn't remember that we shall do the lecture today. I was trying to go through some works and to present more at the APC. So let's see the little we can do. I hope you appreciate that. Please, where did we stop in the last lecture? We had some discussions. Governor.
Sir, I'm with you, sir.
Do you remember?
Yes.
Yes.
We talked about investment, diversification of investment.
I don't know whether able to treat as many as possible. That's diversification. The strategies. Okay. So of course we already know the direction we are towing management, and when we talk about asset, I'm just going back a little. That asset captures both inventories that you can find in a company, and as well as other investments that can generate return for the investors. And in the case of portfolio now, the consign is on the later, which of course refers to other investments that can generate returns for the investors and not the inventories that you can find in a company. So when a company or an individual has other investors that can generate return them and they are perceived as one, we call that a portfolio. So we are looking at these investors today. How can we classify them? There are a plethora of ways we can perceive them or classify them, but we'll just look at just very few. These investors can be classified in terms of, or looking at it from the perspective of foreign and local investors. So when you talk about local investors, they can be found at the metro level. They can also be found at the regional level. And what that means, I can use properties as an example. Property is the best example to use in this case. Why? Because the investors, whether individual or institutional, that's whether it's a company or an individual, can have his investments, all the investments diversified within a local government. That's metro level. That means you can come in a local government and see properties in different directions in a local government. It's still diversification because no two properties are the same by virtue of location. So the risks that are attributable to them are not the same. So you are actually diversifying and spreading risk by having your assets in different locations. And you can have diversification also at the state level, meaning that you have your one in Port Harcourt, another one in Calabar, and so on and so forth. Sorry, Cross River, and so on and so forth. So that's the state level diversification. Then you can also diversify at the regional level. Take, for instance, Northeast, Southeast, and North Central, and so on and so forth. That is regional level diversification. And all these are also ways of trying to minimize the risk that are attributable to the investments. That the essence of focus is to have different investments that have different risk that are attributable to more return risk characteristics. Let me put it like that. Have different investments that have different return risk characteristics. The essence is that you are trying to create a scenario that you are not putting all your eggs in one basket, because if you do so, that means that if the basket drops, all the eggs will crash. So you're actually spreading risk. So, and that is diversification. Those three diversification or those three areas are very key when you are talking about the local investors. All investments are within an economy or a country. But when you talk about the foreign investors can have their investments within the country and outside the country, or they can have their investments only outside the country. So a foreign investor can invest at the metro, state, and regional level, as well as having cross-border investments. Or the foreign investor can only have a cross-border investment. So that's the way, one way of classifying these investors. We are looking at the classification of investors. We are not looking at actually the diversification strategies, even though in this first explanation, I was able to key in diversification strategies in the course of trying to make this explanation. Then we have another classification in terms of looking at the risk tolerance capacity, or the risk tolerance, let me put it like that, of the investors. So when you want to look at the risk tolerance of the investors, we know that some investors are risk averse. Some of them are risk-prone investors, and some of them are risk neutral or risk indifferent investors. So these are the three categories when you are looking at investors in terms of their risk tolerance capacity. So you can take this. A risk-averse investor is known to take calculated risk and will demand maximum return at a given level of risk, or the minimum risk at a given level of return. So among various investment options that have the same level of returns, but different levels of risk, that's what we are saying. This rational investor is a rational investor will likely prefer the alternative with the least risk. In addition, the investor will likely prefer lower returns with known risk rather than returns with unknown risk. So he needs to understand the risk that is attributable to an investment. So he's always looking for, at a given level of return, he's looking for the investment that had the lowest risk at a given level of return. Or at a given level of risk, is looking for the investment that has the highest return. That is what the risk-averse investor is looking for. But he's much bothered about risk, so he doesn't want to take risk. And you remember that in investments, you are told that the slogan is that the higher the yield, the higher the risk. So it's not ready to go for higher yield because of the risk that may attribute to those investments with high yield. So his concern is basically on the risk. Then you have another type of investor who is the risk-prone investor. A risk-prone investor is a risk acceptor. He's ready to take risk as long as he will get high yield. So he's a risk-prone investor. He's a risk acceptor who is willing to take more risk for a given level of returns. So what we are saying in essence is that for a given level of return, he doesn't care. His concern is that let him make that return. He's ready to take any risk. Do you understand? To make sure that he enjoys the return, as long as the risk does not nullify the returns he's going to get from the investment. is ready to take that risk. So it's a risk acceptor. This suggests that if the investor can decipher that the probability of achieving a level of return is higher, he will not mind up for the higher risk. Okay, so we now have the third group of investors, who are the risk neutral or the risk indifferent investors. This refers to the investors who are indifferent about risk. They are indifferent about risk. They are not bothered about risk. That's why we call them the risk neutral or risk indifferent investors. They don't bother about risk. And you know, when an investor is not bothered about risk and he just jumps into an investment, he's actually the risk taker. He's actually the risk taker because he's not bothered. Anything can happen to him. He bears the highest risk. He does not do any analysis to know whether he will jump into the investment or not. So they are indifferent about risk. So they're actually the highest risk takers. This investor will consider investing after deliberating or brainstorming only on the return. So it is the return that incites or motivates them to jump into an investment. The risk neutral investor places himself in the middle of the risk spectrum, represented by the risk-seeking investor on the one side and the risk-averse investor at the other end. The investor does not factor risk. How do I put it? The investor does not factor risk management strategies, yes, risk management strategies in making investment decisions. Just like I say, it doesn't factor risk in making investment or risk management strategies in making investment decisions. He just jumps into the investment, and that makes him the highest risk taker. The risk neutral investor is essentially the risk taker by virtue of the fact that the investor possessing this attitude disregards the damages which risk can cause to investment if not given appropriate attention. I hope it's clear. So we can look at another classification. Maybe after this we can move to other things. We can classify these investors in terms of whether they are institutional investors or individual investors. In the case of individual investors, these investors usually lack the resources to carry out extensive evaluation and analysis before investing because they have limited resources. So we have them in the form of direct and indirect individual investors. So the direct ones are those that will have to manage their investments by themselves without handing it over to fund managers. But indirect ones, examples of indirect investors could, in this case, could be the shareholders or the bondholders. They don't manage their investments, but they hand it over to either institutional investors or mutual fund to handle on their behalf. So what the mutual fund may do is to get a pool of funds from members of the public who can be referred to as shareholders or bondholders, and now invest it, take the administrative fees and their reserve earnings, and whatever that is left, they can declare as dividends to the shareholders or bondholders after having paid the preference and the cumulative shareholders if they are present. So you need to, take note of this. So why the direct investors engage in direct investment, the indirects engage in investment indirectly by buying their shares that are buying whatever assets that has been converted to paper or assets in the form of securities. Okay, in the form of securities. So in the case of institutional investors, what you have, unlike the case of individual investors, we have okay, let me put it like this. Just like we have in the case of individual investors, in that case of institutional investors, we have the direct and indirect investors. We have both, we have the direct and indirect investors. Institutional investors refer to organizations, usually with excess funds, who engage in investment activities. There can be mutual funds, banking and non-banking firms, pension funds, insurance firms, etc., are firms with a large amount of surplus funds to be invested in various profitable avenues, especially the real estate option. So you see, the same way we have in the case of individual investors, direct and indirect, the institutional investors can also engage in direct and indirect investments. So when we are talking about pulling fund, a fund pulling fund from members of the public, it might not be pulling fund only from individual investors. Some of the people or companies investors is getting fund from can also be institutional investors. That's what we are saying. So I think at this point, we have to move on to some other things which may matter. We have to look at the preliminary aspects of assessing portfolio risk and portfolio returns, or determining portfolio risk and portfolio returns. And we said that you cannot do portfolio analysis. The analysis we are talking about is analysis of risk and return of portfolio. Remember that we said earlier that a portfolio is a set of investments perceived as if they are one because they are owned by a person or an institution. So, and we discussed earlier that just like you have 7 colors in a rainbow, but one rainbow, the same way you have portfolio, different investments, but look at as if they are one. So when you are calculating their risk, the risk should be only one risk. The return should be only one return, because you are not looking at their individual returns at the portfolio level. But we are saying that before we can get to that portfolio level, we need to find we need to do a security analysis. Security analysis entails determining the risk and returns of the individual investments that make up a portfolio, because the risk and returns of the individual investments that make up a portfolio are inputs in determining the risk and return of the portfolio. I hope it's clear. The individual returns and risk that make of investments that make up a portfolio are inputs in determining the risk and return of a portfolio. So that means that before you can do portfolio analysis, you have to do what you call the security analysis or the asset analysis. Asset is referring to the different investments that make up the portfolio. And the analysis we are talking about is analysis of risk and return. We need to, and for us to do analysis of risk and return, we need to understand the risk-return characteristics of the various investments that make up a portfolio. So that means every analysis starts at the security or asset level. How do you now determine the risk of an investment? You can determine the risk of an investment using the standard deviation or variance, while you can determine the returns on an investment using the arithmetic mean or the geometric mean. But having done that, this will now serve as inputs in determining the portfolio returns, because all the individual risk of investments that make up the portfolio And all the individual returns of the investments that make up the portfolio are used as inputs in determining the portfolio return and the portfolio risk. So the model determining individual investment returns is the arithmetic or geometric mean, while for the risk is the standard deviation or variance. But at the portfolio level, we use the portfolio risk model or the portfolio return model in determining either the risk or, in the case of the returns. So, having said this, we may have to start looking at some of these calculations. And that's where I'm saying I may have a little challenge presenting them online, but you have to try as much as possible to get what you can get for now. Maybe some subsequent lecture, I will re-strategize on how to, pass across this information to you. So now, when you have a set of investments that make up your portfolio, let's say there are 5 investments that make up your portfolio. These investments, they have what you call the historic returns. Returns they have generated over the past years. So, when you look at these returns, for each of the investments, the average, which can either be using the arithmetic mean or the geometric mean, gives you the return for each of the investments. Am I communicating? The average gives you what? The return for each of the investments. So if you have 5 investments and they have historic returns for the past 5 years, the average of each of the historic returns gives you the return for each of the investments. I hope it's clear. Any question? Any question? Hello?
No question, sir.
It's clear, right? That means that in case you are considering 5 historic returns, that means on an annualized basis for each investment, you will have a total return. In the case the portfolio is 5 portfolio investments, have 5 investments, you will have a total return of 5 by 5, that is 25. That you have 25 returns in the set. Am I right? 25 returns in the set. But we are saying that it is the average of the historic return for each investment that will represent that investment. So you get the averages for the 5 investments, they will represent the investment. It is these various returns coming from each of the investments that will be used in calculating the portfolio returns. In the case of the risk for each of the investments, you need to get the standard deviation or the variance of the historic returns. It is the standard deviation or the variance of the historic returns for each investment. That is what represents the risk of that investment. Okay? Now, we have said this, but we need to understand how these returns are even treated when we are dealing, we're dealing with portfolio management. How do you come about these returns? These returns can be calculated by saying, assuming institutional investors are managing it, and we are dealing with indirect investments, you can talk about today's price minus yesterday's price over yesterday's price times 100 over 1. So when we are looking at it in terms of indirect investment, we are talking about securities or shares. So for you to calculate, because what you will see is share price, for you to translate it into returns, it will be today's price minus yesterday's price over yesterday's price times 100 over 1. So when we mean yesterday, it depends on whether you are calculating the return on either monthly basis, quarterly basis, biannual basis, or yearly basis. So that yesterday could be referring to anything. It could be referring to 4 months, 6 months, 12 months. So, but the formula is today's price minus yesterday's price over yesterday's price times 100 over 1. So if the price is for shares, what you will have at the end of the day is the returns on shares. If the price is for bond, what you will have at the end of the day is the returns on bonds. And the returns on bonds that goes to the bondholders are referred to as coupon, while the returns on bonds, on the returns on securities that goes to the shareholders or equity holders are referred to as what? Dividend. Who is that, please? Hello? So while the returns on securities that goes to shareholders are referred to as dividend. Okay? So now, if can I continue? Hello? Hello, can you hear me? Can you hear me?
You can continue, sir. You can continue, sir.
You can continue, sir.
Okay. So when you want to determine the total share return, it is determined using dividend in the case of shares over yesterday's price times 100 over 1 plus today's price minus yesterday's price over yesterday's price times 100 over 1. So that is the formula you use to determine the total share return. In the case of total bond return, you replace the formula you have dividend with coupon. Am I communicating? Why did we say this? Total return is actually equals to income return plus capital return. So when we say today's price minus yesterday's price over yesterday's price times 100 over 1, we are talking about the appreciation in the value of share, and that is the capital. That is the capital gain. Remember the definition of investment, which captures both the income return, the stream of incomes that comes from an investment, and the capital gain. So in this case of indirect investments where we are dealing with securities, we are saying that today's price minus yesterday's price over yesterday's price times 100 over 1 is the capital appreciation. It is the increase in the value of the share. But now what is the stream of income that now goes to the share is referred to as the dividend, and that dividend is referred to as the dividend. That's the income stream, and that dividend is calculated as dividend over yesterday's price. The return, do you understand, is calculated as dividend over yesterday's price times 100 over 1. That's the income portion of the investor's return. The capital portion is the other one I mentioned. The total portion, which is total return, is the summation of the two. And that's why I'm saying that total return per share is dividend over yesterday's price times 100, bracket close, then plus today's price minus yesterday's price over yesterday's price times 100 over 1. In the case of bond, all you need to do is to remove the nomenclature dividend and replace it with coupon, because coupon is the terminology you use in the case of bond, but the formula is the same for to calculate total return. So you should know how to calculate the total returns of security, whether it's share or bond. You should also know how to calculate the income returns from shares, the income returns from bonds, as well as the capital returns from shares and the capital returns from bonds. So now that is for indirect investment. In the case of direct investment returns, we have some measurement problems. Please, can I dictate a small note here? Can you take notes? Now, in the case of measurement problems in the construct of direct measurement problems we have with direct investments. Why? Because most direct investors will not be open to reveal to you the returns they make from their investments. Why is that so? It's because it's common in most developing countries, especially Nigeria, because of the mentality that you have to be your brother's keeper. So most people don't want people to know what they have, because they might end up coming to start disturbing them. So the problem of data is usually the case. Please, hello, I may not be able to explain what return relative is, but if you Google online, it's very clear there, so that we can move on to another thing. I'm very brief. Then look at return relative online and look at cumulative wealth index. Maybe if it is not clear in subsequent lecture, I'll break it down, but I may not be able to explain that now. The cumulative wealth is simply referring to the geometric mean. So if you understand what geometric mean means, then you definitely know what cumulative wealth index connotes. And relative is an input in determining the cumulative wealth index. So please look at it. There are ways of determining returns and see whether you'll be able to make out anything from that. But if at the end of the day you cannot, then we'll explain it in just a few minutes. There's so much to cover. Real estate return index, facilities return index. Governor. Hello.
I'm with you, sir.
Please, was there a video I sent to you?
You sent me a video where somebody was trying to, a lecturer was trying to analyze something. I sent it to the class.
Okay. So that is all about, I think that video is about systematic and non-systematic
risk. Yes.
So summarily, please, you have to read up because the calculations consume much of our time. So I don't want to belabor on, but summarily, what they are talking about there is about systematic and unsystematic risk. So, and they are telling you that the risk that is peculiar to investments directly are referred to as what? The unsystematic risk. Why the market risk? The risk that affects all investments in an economy can be perceived as the systematic risk. Another point you need to know there is that the unsystematic risk are risks that can easily be diversified away, while the systematic risks are risks that cannot be easily diversified away because it affects the whole economy. So the unsystematic risk is also referred to as diversifiable risk because the risk can be diversified away, while the systematic risk can also be referred to as the non-diversifiable risk because the risk cannot be diversified away. Systematic risk refers to the component of the total risk of an investment that is associated with the market and which cannot be reduced by diversification. It can also be referred to as what? The non-diversifiable general. Some call it general, some call it unavoidable, some call it non-specific or market-imposed risk. The risk affects the entire market and is caused by factors which are external to an investment and hence uncontrollable by the investors and investment managers. So it means the investors, investment managers, or fund managers, or even portfolio managers cannot comfortably manage this risk because they don't have what it takes to spread risk since it affects the whole economy. We can also consider systematic risk in terms of the external business risk. External business risk here refers to it refers to the risk. David, please get me water. Get me bottle. Okay, don't worry. I'll see. It refers to the risk how do I put it now? External business risk refers to the risk of unfavorable operating conditions that are beyond the control of an investor and the investment firm, but can affect the performance of the firm. So let's give an example. Example of factors which are beyond the control of individual and corporate investors are things like wars, political situations, because a company cannot control outcomes or an investment company. So we can think of factors like wars, political situations, maybe sociological changes affecting security market and the economic condition. Example are things like inflation, exchange rate, the likes. So this can be perceived as factors beyond the control of a firm. I hope it's clear. So in the case of unsystematic risk, we are talking about the risk that refers to component of the total risk can be controlled by diversification. they can be controlled by diversification. So what we are saying in essence is that total risk is made up of systematic and unsystematic risk. So, but that the portion, there's a portion that can be diversified away, which is the unsystematic portion. But there is a portion that cannot be diversified away, which is the systematic portion. So the unsystematic portion refers to those ones that can be diversified away. And this kind of risk affects only the investment or the firm or an industry. It measures a part of the total variability of an investment's returns. This part of the total variability of returns can be the result of managerial inefficiencies or changes in the consumer preference, as well as labor problems. Okay. So we can classify them into firm-related business risk and financial risk. I am not really interested in all these theories. Okay, let's see. Mr. Beloy. Hello? Hello? Can you hear me?
I can hear you, sir. I'm with you. Sorry.
I am thinking of the way we can have, it's possible for us to have so that
it's possible, sir. We can use that main hall and we can spread ourselves with our nose mask and mouth mask so that at least we can spread very well in the main hall.
Let's see how we can work it out. What I want to do is not something I can, but will be sounding out.
Okay, sir.
So I think I might have to stop here.
Okay, sir. Okay, sir. So I think it's better for us to come and see so that we can ask questions as you are doing it. And
so when can we
could you please allow me to just meet the class so that you said Friday. I think Friday is fair. If not, let me just ask the class. Let's have Friday.
Yeah. That is it, because there are so many calculations to handle, and I don't know how them, you know. If you look at the past questions, you also see
No, I think that's the best solution, sir.
Okay.
So if we come to class, we use the main hall so that we have enough room.
So okay, it's all right. So maybe we have to call it a day here.
Okay, sir. I'll be with you on Monday.
All right.
Thank you, sir.